The US Federal Reserve surprised investors with a more aggressive forecast for monetary easing next year. The US Central Bank held interest rates steady for a third meeting in a row at a 22-year high and flagged the end of its tightening cycle. The tone, too, was dovish, with forecasts penciled in for 3 rate cuts next year. US Fed Chairman Jerome Powell made the announcement while addressing a news conference. Listen in.
Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5% and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective.
US stocks surged to hit fresh highs for the year, and benchmark Treasury yields slipped to their lowest level since August. Now, the market rally came after the Fed delivered an early holiday present this year. The dollar reversed its gains against major currencies, dropping after the central bank signaled rate cuts are coming. Now, in the lead up to the policy decision, there were broad expectations for another hawkish stance that would have pit market bets for earlier rate cuts and the Fed's rhetoric for higher for longer rates. Now, the central bank surprised everyone with a dovish tone. Traders embraced the change in the Fed's tone and dialed up their bets on rate cuts. All right. Now, in this edition of World Business Watch, we're being joined by a very special guest. This is WION's business editor, Rahul Karunakar. Welcome on your show, Rahul. He's the man behind, he's the brains behind World Business Watch. Glad to have you in the studio finally.
Thank you, Shivan. Interesting times.
Yes.
Thank you.
Rahul, let's just start right off with this. Now, this dovish tone that has come in, it's definitely been extremely surprising for a lot of people. What were the factors which influenced the Fed to surprise markets with this kind of a dovish tone?
I think even until yesterday, even before the Fed's decision, the broad expectations were that the Fed would maintain its hawkish stance, higher for longer. We are looking at inflation. We need to bring inflation back to the target, all of these aspects. But I think inflation has eased over the last 3 months. And they are seeing that if they make a wrong move now, then it'll be like they're making a mistake like they did earlier in 2021, when they said, when inflation surged and almost every central bank in the world called them temporary or transitory in nature, but that took hold and they were aggressive. Also, I think they had to look at something before the end of the year. They're priming the market for rate cuts, but the surprise was they did what they did. They forecast 3 rate cuts next year, and that's surprising for almost every trader out there. And we've seen the rally. I think the November rally will extend into the year end now. And I think it is a present to the markets early for the holidays.
So if we just take a little further from here, if you just broaden the scope over here and to figure out what kind of repercussions, or I would say what kind of consequences or impact would it have on global markets and India as well, if you can talk to us about that.
I think it's clear that the Fed's primed markets to rally towards the end of the year. And I think if you look at rate cut bets, now everybody's betting the first rate hike can come as early as March. Obviously, the dollar is going to fall, right, because of this entire dovish tone from the Fed. The dollar's rallied through the year, but right at the end of the year, it's falling. And that's actually good for a lot of emerging markets, specifically if I have to talk about India as well. The rupee is almost close to a record low. It's trading over 83.
Right.
And if you look at, but our forex reserves are fantastic. We are back up to 600 billion, which means India is not in trouble as such. But the neighborhood is. Pakistan's gone through a crisis. Sri Lanka has gone through a crisis. So as now we're seeing Bangladesh going through a crisis. All 3 countries are looking for a bailout from the IMF to save them from the crunch.
Absolutely.
So a falling dollar will give some kind of relief for these countries. So And globally also, I think the Fed's, there were discussions about a global rate standoff between central banks and markets, but the Fed has eased that in and has not tried to disturb global markets at this point.
Perfect. It's always good to hear your insights on this. I've always enjoyed hearing from you because you really, explain in a manner which is easy to understand for anybody, keeping all the jargons aside. Thank you so much for joining in. This was WION's business editor, Rahul Karunakar, joining us on World Business Watch.